The art of this business is knowing when to do something, and when to do a little bit, and when to do nothing. We believe that by making informed judgments, you're not going to be perfect, but you're going to be right more than you're wrong, which is a big part of our success.
What do you think has changed the most over time, and what hasn't changed?
The fundamentals of investing have not changed, but dealing with more information and having to deal with things quickly, I think that's a significant difference.
There are a lot of folks who want to get involved in our business as investors. What would you tell your 1993 self today?
And I think one of the lessons of investing is that
today we have Andrew Suzman with us. Andrew's been at Capital Group for 31 years. He's a portfolio manager based in New York. Andrew, welcome.
Nice to be here.
Glad you're here. This will be a fun 30, 35 minutes. I know you well, and I know you're a lot of fun. So we're gonna have a good time doing it. I want to start off by talking about you knowing Capital before joining Capital. A lot of our guests have had that, where they've been introduced to Capital Group in some way before they actually became associates. Why don't you start off by sharing that story with us?
Well, in my case, my mother had gone back to school and became a psychologist. And when she started working, she started making extra money, and she had a financial advisor who was at the old A.G. Edwards, now part of Wells Fargo, who said you ought to start buying growth and income American funds as part of your savings program. And so, while my mother loved to buy growth stocks personally, fortunately, she had a clever advisor who had her buy our funds, and that turned out well. And when I interviewed at Capital, she was thrilled, and my father, who's still with us, still has these funds which he uses as part of his retirement plan.
Now, was your mother a better allocator to advisors or stock picker?
Well, my mother loved investing in growth companies, we were from Atlanta, and so she owned Coke and Home Depot, but really her serious money was in these growth and income funds. And it really was a real-life case study of how a good advisor can make a big difference. We saw it in our own family, and it made a huge difference, and she stuck with it even when things were rocky, because the funds allowed her to do it.
It's interesting. We always say individuals are best served through financial advisors, and that's such a good example. You started off in commercial real estate in a combination of Texas and Oklahoma. And when we had our conversation beforehand just a little while ago, you were talking about the difference in being an agent versus an investor. Tell us a little bit about that early experience as an agent.
Well, my first job out of college was in Tulsa, Oklahoma, and it was right after the S&L crisis. And there was lots of real estate that was for sale. You could buy office buildings in Texas and in Oklahoma that yielded 10%.
Right.
And they were well leased to good tenants, but you couldn't give these buildings away. But there were a few sort of courageous buyers that were buying office buildings yielding 10%. And I thought, well, it's interesting to sell these buildings, but it'd be more interesting to sort of have an investment opinion and to buy them. So from there, I went to business school with the goal of trying to, become a professional investor.
All right, I'm going to put you on the spot. Oklahoma or Texas, which did you like better?
Well, I spent my time in Tulsa. I lived on Tulsa time, so I had a great experience there.
Okay, 30th anniversary. Let's talk about 30 years. A lot's changed in the industry, at Capital Group, and you're a big culture person here at Capital Group. You mentor a lot of folks. You talk about Capital Group a lot. What do you think has changed the most over time, and what hasn't changed?
Well, what's interesting is how much hasn't changed. When I joined Capital in 1993, I guess it was the same year Martin Romo joined, we were not joining a small firm. Capital at that time managed approximately $100 billion, which was huge. We were joining one of the most established, most successful investment management firms. And what's been amazing to see is our ability to sort of innovate and continue to be a large, successful firm. And so the culture has really stayed remarkably similar. I attribute that to the fact we've sort of always broken into these pods of groups, and we've always worked so hard in the investment group at keeping a small company feeling, which I think is just critical to achieve superior results.
100 billion to nearly 3 trillion. So in 31 years, 30 times assets higher. So very linear in that regard. Managing money at scale. We have $3 trillion. We have 400 investment professionals based in 30 plus offices around the world. Some things have changed in terms of the democratization of information, how we work together. What in that space do you think has had the most amount of change? What feels the most different to you?
I mean, the sheer amount of information that's available, and you have to sort of process more information, and the fact that information comes at you so much more quickly than it used to. So it's dealing with more information coming at you quickly, and the world's time horizon has narrowed a bit. And so I think dealing with all of those things is part of the challenge today, which is new. But the fundamentals of investing have not changed. And the fundamentals of working with people have not changed. But dealing with more information and having to deal with things quickly, I think that's a significant difference.
And you talk about the volume of information. It's also the velocity. So that leads to this volatility in the markets, and you got to look at the long term to try to see the way through that haze, because every day there's a new news story, sometimes true, sometimes not true, but it moves the markets. And so that media and the velocity of information and the velocity of news really does have this volatile impact on the marketplace. Our primary driver for investment results for you and for other investment professionals is the 8-year results number. So how do you think of that long-term results number when you're seeing all this noise every day?
Well, the art of this business is knowing when to do something, when to do a little bit, and when to do nothing. And if there was some absolute rule which said, well, every time this happens, stay the course, and every time this happens, sell everything.
That would be nice.
That'd be nice, but there isn't. And this business really is an art in addition to a science, and the judgment that you have about when to take action and when to stay the course is what makes the difference in having a superior long-term record versus an average one. And that's what, we aspire to have superior results. And so there's no one rule about when to stay the course and when to act, but we have a mosaic of information. We'd like to make informed judgments, and we believe that by making informed judgments, you're not going to be perfect, but you're going to be right more than you're wrong, which is a big part of our success.
That makes sense. It makes sense. When I come and visit you in New York, we sit in seats like this, without the fancy microphones, but we sit in seats like this. And usually you're the one interviewing me about Capital Group, and I like that. Today I get to interview you. So in your office in New York, as we navigate the office treasure hunt, knowing you were going to be on this podcast, I happened to steal something. You probably haven't missed it. And what it is a gold-painted calculator. Tell us about why someone painted this calculator gold, and why is it in your office?
Well, Brad Freer gave that to me after I finished being a research director. Brad and I both were investors in Australia. And if you can envision a world, Mike, before laptops.
I can envision it.
The HP 12C was your laptop. That's what you sort of did to run numbers. But to this day, I still like to use a calculator when I go in and see companies, because one, I find that when you're talking to management, you're looking at them, and if you're kind of running numbers and they're of a certain age, they sort of have a nostalgia towards the HP 12C. But it also, to me, it's the numbers which speak to me. There's people, and then there's the numbers behind the business, and when they sort of make sense to me, that frequently gives me the courage to invest. And so Brad gave me this lovely gift, kind of poking fun of the fact that I love my 12C, and you managed to fish it out of the office, but I'll bring it back with me.
You'll bring it back with you. You don't trust me to send it back. Brad was a recent guest on here, and a lot of our podcast guests, a lot of our investment professionals talk about the importance of management. You talk about the importance of numbers. But where is the importance of management on your list when you're evaluating potential investments? Is it number one? Is it number three? Where is it on your list?
I think management is critical. I mean, the numbers are the output, and anyone can tell you a story, but management is what make the numbers happen. So management is critical. Do they have integrity? Do they have insight? Are they realistic? Are they promotional? All of these things matter greatly. So the numbers are just my little crutch, which is sort of the output. But really what makes the numbers happen are managers and the industry they're in. You know, Warren Buffett famously said, a bad industry will eat up good management time and time again, and that's true. So we have to really assess both. Is this industry attractive?
Right.
And are the people running this business going to be good stewards of capital and good managers? And our job is to do industry analysis, to analyze management, and then the output of that are the numbers which come out of the business, and that's how we make the decision.
No, that makes sense. It's a byproduct.
Right.
About a year and a half ago, you said there are three important things to keep in mind. I remember you saying this. And you said valuations will matter, balance sheets will matter, and avoiding disasters will matter. Do they always matter?
Well,
They matter then, but do they always?
Well, Mike, in our business, always is a big word, and I think
a long time.
Yeah. I think we're mostly in a business of things mostly matter as opposed to always matter. But this is what we do know: we know that a year and a half ago, even if you were a great growth investor, which I am not, but if you were a great growth investor and you were looking at NVIDIA, which traded at 45 times earnings, you might say, well, that's expensive. But it turns out that if you had bought NVIDIA 2 years ago, it was really at 5 times this year's earnings. So Drew Macklis, our very clever analyst, had dug in and thought the 45 PE multiple for NVIDIA isn't that high, because really the valuation is much more reasonable looking forward. The growth investor looks to the future. Even the great Mark Casey will say, I want to look at valuation in the future. I am also very attracted to valuations in the present, because it gives you a margin of safety. And what I'm interested in are buying businesses where the price I'm paying today does not require me being a total seer of the future in such a direct way. And so I think that, does valuation matter? Yes, it certainly does. Does it always matter? Sometimes less and sometimes more. But I think, ignore valuation at your peril over time, because it's just so foundational to investing.
Well, and the growth investor, they're looking at forward PE and not current PE.
That's right.
And when we interviewed Mark on this podcast, Mark kept talking about the value of the capital system, in that Andrew Suzman may be a value, quote unquote, focused investor. I may be a growth one. I may try to have 15% annualized returns. He might try to have 7, but when you blend them together, you can beat the market over a long period of time. You focus on cash flows, and it's an important metric for you. Where are you seeing opportunity today? You can either pick stocks, sectors, but where do you see value in the market right now?
I'm not going to mention their names, but there's a U.S. pharmaceutical company that I'm looking at, which trades on today's earnings at 11 times earnings. And they have a GLP-1, which is part of the weight loss drugs, where the market is giving them no credit that they will come in and compete with Lilly or Novo for this drug. Now, their management thinks we have a shot here. And if they do, in addition to their existing portfolio, you'll have something very powerful. So
it's
to me,
about a free option.
I think so. I think the option there is underpriced. Another company with a low-priced option is a German insurance company that owns a U.S. asset manager. In addition, they have a general insurance business, and they really think they can grow earnings 8 to 10% a year, and their U.S. Asset manager is doing quite well, and you're paying 10 times earnings for this business. And so the market's assuming not a lot goes right here, and they're certainly not assuming that management's aspiration of growing earnings and the dividend 8 to 10% a year for the next 3 or 4 years is going to come to fruition. And so I look at these things and I say, I'm not paying too much for some good things that may happen in the future. And in the here and now, if things are just okay, I'm going to be fine. And
so let me ask you a question, though, on the German insurance example.
Mm-hmm.
How much of that PE discount is based on the geography of where the company's domiciled? Because is it the case of it being a really interesting property and not so interesting of a neighborhood relative to the growth prospects of Europe versus the US? How much of the discount do you think is based on that versus how much others haven't found as much value in the US asset management company, which might grow as quickly as you think?
I think that a lot of it is based on domicile. The last decade has been an incredible period for innovation and growth and U.S. equity returns, and it's really superseded what we've seen outside the United States by a large margin. The company I just mentioned, I think if they were listed someplace else, and I'm not suggesting they're going to do that, nor should they do that, but were they listed someplace else, I think the PE might be 13 or 14 or 15 instead of 10 or 11. So I think this is a case of the businesses are being treated differently because of the country of domicile. And I think there are lots of examples of that. Yeah. And so I think it's an interesting area to sort of dig around in.
It's good to keep in mind this new geography of investing mindset. I don't know the exact numbers, but if you're a company in Japan, Europe, or the UK, you may generate 50, 60, or 80% of your earnings outside of that region.
Right.
So trying to figure out where their customers are and where they're generating their revenues is more important than where their domicile of listing is.
I think that's a powerful insight. And thus far, being domiciled in the United States has been so powerful.
For the last 15 years, for sure.
And so I think part of the opportunity is to see if a business is domiciled outside the United States and the valuation is just a function of domicile as opposed to the underlying businesses, which was inherent in your question.
How much do dividends matter to you? So you are more of an income investor, but the growth of dividend and the existence of dividend, how important are they to you in your thesis?
Mike, dividends matter to everyone, okay? Right. So let's just say that. If you look at the total return of the U.S. stock market going back 100 years, through every era, when growth was great, when it's not so great, about a third of your total return comes from dividends and reinvesting dividends. Right. And so if you ignore them for the very long term, you're going to do worse. Now, we've been in a period where some of the great companies are companies that don't pay particularly high dividends and have been reinvesting in their businesses and done really, really well. And that's certainly been true over the past 15 years or so. I suspect that in the fullness of time, that dividend and dividend growth will be important things to keep in mind, not for every company, right? But for the market in total. And so I think it's an important discipline for investors to keep in mind in the broadest sense.
And we talked about valuations, but when I've heard you speak about it, you say cheap isn't good enough. Meaning just because something is cheap doesn't necessarily mean you want to own it. It has to be growing as well. Talk about how you think of growth versus valuation in a certain entity.
Well, my grandfather used to say, bad bananas cheap. You don't want to pay a low price for something that's not so good. And so I think that cheap is not enough. Okay, cheap. For a business going backwards is a disaster. And I think one of the lessons of investing is that you really want to avoid businesses that are getting run over by regulation or technology. I mean, we look at Xerox or Eastman Kodak that really face difficulties. IBM has, wonderfully reinvented itself. There's an example of a business that, had a difficult time and has reinvented themselves. Right. But take the IBM example. A few years ago, IBM was trading at 10 times earnings. And so there was great skepticism about their ability to reinvent themselves. And they've certainly done a lot of very interesting things. And now the PE is in the high teens versus 10. So there's an example. If you can identify a business where you think they can make some progress and you're paying a low price, that's what we're looking for. What you're not looking for is a low PE with a business that's going to face technological or competitive threats that are going to be really detrimental to the business over time.
So IBM avoided their full Kodak moment.
And yes, they certainly did. Certainly relative to what the market expected many years ago.
We always chat with our guests about something they learned through a tough moment in investing. I'm going to ask you about that, and then I'll let you come out of that with strength by talking about your investment edge. But give us an example where, whether it's earlier in your career or more recently, where things just didn't go as you had planned and what you took away from that. Because I've referred to this podcast as a bit of a master's course in investing because of folks like you joining, not because me asking the questions. And I love hearing the lessons learned.
Well, I mean, there's so many. Okay, so we could spend literally hours going through war wounds. But one that really stood out to me was early in my career. I invested in an Australian construction company, and they had a very charismatic CEO. Everything was great. Everything was perfect. And I really just took him at his word and didn't, dig a little deeper. Didn't talk to customers, didn't talk to suppliers. And so just did primary research talking to the company. And that ended up very, very poorly. But with the benefit of hindsight, if I had spoken to customers, if I had spoken to competitors, I would have seen that, all the glitters may not be gold,
right,
and would save me some serious aggravation. So I think that, we can do all the work in the world and still get it wrong. But that was a case where I didn't do all the work. Okay, so I think that if we're going to make mistakes, let's make them the old-fashioned way by doing all the work and having a judgment that goes wrong as opposed to taking shortcuts. So I thought that was a super important message.
That's such a good lesson, because you're absolutely right. There's so much more information you can dig into, but early in your career, you could be swayed by that charismatic leader who's telling you everything you want to hear.
Right.
And I think that is a great lesson for anyone who wants to be an investor. Investment edge. Everyone has their unique edge. What's Andrew Suzman's?
Well, I'm not afraid of simplicity, and I'm not afraid of believing in the capital system and following our analysts. And then I'm not afraid of being consistent on a valuation framework, even when the market is saying there's something more glamorous elsewhere. So are these existential edges? I think in time they've been enduring, which is if you pay attention to valuation, you work with smart people and you trust them and follow them, and then you try to stay away from the most complicated things. I think that that's a recipe to be above average over time.
Let me dig into that capital system comment. 31 years you've been here. Today you're chair of our capital research management company, so you know Capital Group as well as anybody. Why does it work so well? Why is it so different? I have my view. Everyone has their own way in which they may describe that. But to you, why is it so different? Why is it so important?
Well, I think we have a number of important advantages. We're a private company. That really helps. We can take a long-term view. We hold people very accountable. Everyone is measured here. We agree on what the truth is, and then we try and measure it. And then we hold, even though there's lots of people all buzzing around, it's not chaos. It really is. It really is each person being measured versus something very particular. And our belief is not that everyone is going to be perfect every year. Far from it. But if we can be right 55% of the time, then we have a real edge. And I also think having a long-term perspective matters. Imagine this, Mike. Imagine if there were two teams of people. One team was measured on how they did this year, and one team was measured on how they did over 5 and 8 years. Would you see different behavior?
Absolutely.
Yeah, and I think that that's a big part of it is being focused with a longer-term horizon. I think makes a big difference.
There are a lot of folks who want to get involved in our business as investors. What advice do you have for them? They're coming out of undergraduate school, they're coming out of graduate school, they're looking at investing. They were going to join Capital Group like you were joining in 1993. What would you tell your 1993 self today?
Well, just building on simplicity, read the paper every day. Read the Wall Street Journal, read the Financial Times. If you think you're interested in investing, go earn a little money and buy a few stocks. You don't have to buy thousands of dollars, but you can go open an account and give it a try. If you don't have any extra money, you can do it on paper and test yourself and see if you like it. And I remember joining a game back at Tulane. They had kind of a stock market game where we formed teams and picked stocks. And I thought, this is fun. This is interesting. And, try it. And if you like it, it may just be for you. But all of us are going to be investors. Really, every person listening is going to be an investor in one way, shape, or form. But I think if you want to do it for others, you have to try it on. And I think that's the best way to see if you like it.
That's good advice. Speaking of advice, mentors, give us a couple, one, two, who has made an impact in your career? And again, I know there's many, but maybe pick one or two.
Darcy Kopchow was a great mentor. She was a research director and a friend and just such a wise person. Rob Lovelace was my first research director, a great friend, someone who always would nudge me in the right direction. And, I've been fortunate to work with so many people along the way, who will pull you aside and give you honest advice. And I try and do that now because that's all we have. None of us know, the truth of investing because, it's hard, but we all have something to pass on. And I think one of the special things about capital is people's willingness to sort of engage and hopefully make us all a little bit better.
Well, I see you doing the same thing. When I come by your office in New York, I can't always get in. Someone's in that seat often. So I see you doing the same thing. You have a lot of talents. One of them is investing, but you have to have some hidden talents. I'm not gonna ask you to juggle, but what other talents do you have? What other interests do you have?
Hidden talents.
What do you got?
Hidden talents. I taught myself how to do a headstand. I'm not going to do it right now.
No, we have to do that. I don't know if we can do that here. It's probably not safe. But
I can do it. I can do one. Yeah, you didn't see that coming, Mike.
Well, did you run a marathon during COVID?
I did a marathon. That's a bit too much wood to chop. Right. I taught myself how to do a headstand.
That's definitely a hidden talent.
Yeah.
I want to finish up with gratitude, and we all have things we should be grateful for. For those who haven't listened or watched this podcast for as long as others, one of the reasons I started this podcast was one to show the world how our investment professionals are interesting and unique thinkers. And when I ended the first one with Rob Lovelace and asking him to share a moment of gratitude, it was to remind us all that our list of complaints tends to be longer than the list of things we're grateful for. So trying to turn that on its head, back to the headstand, trying to turn that on its head, what are you grateful for? And I will find the mug for you, our gratitude mug, but what are you grateful for, Andrew, that you want to share?
Well, that's a wonderful question. I'm grateful for my wonderful family. I'm grateful for my friends. I'm grateful to have gotten to work at Capital all these years with so many smart, nice, and interesting people. And I'm grateful for the blessings of faith. And I'm glad you asked the question. Thank you very much.
Good. I'm glad we got to spend 30 minutes together. Thank you for everything you do for Capital Group every day over the last 31, almost 32 years. Thanks for being a leader in our New York office, a leader in the investment group you're in, the chair of the Capital Research Management Company, and so many other things. And thanks for telling me you stood on your head. I appreciate that. Thanks for being here. Thank you all for joining us today. If you enjoyed the podcast, spread the word to somebody else who might benefit from hearing these great stories from our investment professionals. And also, please subscribe to Capital Ideas wherever you get your podcasts. And have a great day.